Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein of Linn Associates with your weekend version of your agriculture update for this Friday, and this is March 9th, 2018. All right, a little bit of rain coming into Argentina, maybe enough to stop the damage, but the damage is there, it's done, whatever it's going to be. But we also have the threats now of maybe retaliation by China down the road on these tariffs that we're putting on. The combination of the two looks to me like it was enough to do in soybeans. And weather markets, remember what I've told you in the past, they don't ring a bell. You've got to start looking at momentum indicators often before price, because often they'll turn before that. And on the daily charts in the meal, it was the first part of the soy complex to turn, losing what we call that embedded reading and turn down from there. And it carried with it then soybeans the next day and soybean oil. I want to remind everybody that this coming Thursday, I'm going to hold a live webinar. Now, how that works is this way. I will be sending out invites from my mailing list. You, if you want to attend, respond. Seating is limited. Very limited. It's all online. You don't need a headphone. You write your questions, but your speakers, you'll hear me respond and answer. The reason I don't have you speak is if I had 100 people, as an example, talking at one time or breathing into their microphones, you really can't hear anything. So I've learned over the years to do it this way. I have not held one of these, I think, in a year or so, and I want to start making them a regular event. Attend it live. I think you'll find it fun. It's going to be Thursday, 12:30 p.m. Central Standard Time, invite only. And it is free to attend the live webinar. Now, I'm going to write a gold report this week as well. So if you're interested in getting that, you might want to go to one of our websites. Of course, go to my website. You'll be able to click up here or underneath us. If you're on some websites, they'll say click here for Ira's free information and so on. I'll come to that at the end of this. All right. But in looking at things, the dollar fairly stable. The events of the week, you now know about North Korea and America supposedly going together, get together and talk. You know about the tariffs that are in place. You know that China has threatened, not recently, they didn't do it in the past 2 days or anything, since the tariffs went on, but they have threatened that maybe they don't have to buy as much soybeans as they do from us. On the other hand, they do have a $375 billion deficit with us on a yearly basis. Would it hurt them to give some stuff up? The president wants $100 billion back. When we take a look at the monthly bar chart, you can see how this market's gone up, and here's your first meaningful reversal. It's not like it was back here, don't get me wrong, but it is a reversal. You're down for the week about 15 I said for the week. For the month, you're down 15 3/4 cents, and it's only March 9th, so we'll see how that goes. For the week, you're down 31.5 cents. The market is still in an upthrust, as I'll call it. It has backed off from this peak, and we can see that peak was at 10.60 3/4. Now you're back down to 10.29 1/4. When we go to a bar chart, I think you can visually just see the market's in an uptrend. And when you take a look at the swing line, and that's what these brown lines are. The brown lines are a technique I developed, an indicator. And on the indicator, what I do is I look at a previous day, and I have set of rules that look to see if the day is a higher high, lower low day, inside trading day, outside day up or down. And then the technique, this will apply and put the vertical points either lower or higher. Always determined the same way, and the rationale there is you can't change it. What this says is that the market is overall in an uptrend until the break low of 967 3/4 is taken out, if you buy into the concept that a bull trend is made up of higher lows and higher highs. I then apply filters. And I teach all this in my charting course, by the way. But the filters are, just in this case, the 18-week moving average of closes. I like to throw the 100-week moving average on, but it is not the filter of the swing line. So when looking at this market can afford a pullback into this whole area, and without taking out 967 3/4 on a weekly chart, still look bullish. When we go to the Bollinger Band study, the market was able, and let's get rid of this. We know this week it was over it, but last week the market closed over the upper Bollinger Band. The week before that, over the upper Bollinger Band. The week before that. So the rule on Bollinger Bands is this. The market can trade above or below the bands 5% of the time, but 95% of the time the market will stay within it. I developed it a bit further, and what I found is that as a rule of thumb, and no, it is not hard fast, it is a rule of thumb, each one of these consecutive days takes off one of those percentage points. Can the market go 7? I've seen it. But you're going to see those this amount of time, and you're going to see the market not go 5. That amount. Got it? And if it goes more than 2 or 3, you'll see that that even is finite. The 5 number seems to be the important number. What's the importance of that, you might say? Because even though you do that, you're not looking to be bearish. It's a question, if one is bullish, should they be taking money off the table? That's the way that I define it. Whenever a market is over the 18-week moving average, I have a bullish bias. It's that simple. So in looking at this market now with momentum of the slow stochastics, that momentum is waning now. It is starting now to flutter, as you can see. It has not turned down. You haven't got the red under the blue, but it is definitely waning. In the meal market, the market had gone, and if we take a look at the same concept, you'd agree last week the market was over the upper Bollinger Band, the week before that. And if we go to this week, it had settled at 340, 380, and that was 340, 70. 4 in a row. What do you think I thought the percentages were? I thought you had a 1% chance of staying over that number by the end of the week. Just what happened. And the market is pulled back. Does that mean the bull trend has ended? No. We're in a correction mode at most. And you'd have to take out 326.20 in order to break the pattern, at least the current pattern, of higher lows and higher highs. Soybean oil, on the other hand, has been in a bear trend for a very long time. And if you'll notice, this market has done a couple of things. Number one, it has stayed under the 18-week average of closes in red. Second thing, you've had now lower highs, lower lows. Third thing, you just had a bearish crossover. That bearish crossover occurred, if you take a look, here you have the 18 over the green, right? So we've got the red over the green. Look at those numbers. Now you get it under. When you go under, you normally go for a lower low. It doesn't have to happen, but again, in charting, you play the percentages. And here comes your lower low. In fact, if you look, 31.28 was this week's low. You took out 31.40. Momentum is still pointing down. Everything on this chart is bearish. Next potential support zone, 31.10, the lower Bollinger Band. The corn market has not responded in a negative fashion to anything. Now, we had the USDA reports this week. And one of the things that broke the soybeans, in addition to everything else that I'm talking about, is what I didn't say, was that the report that came out yesterday showing crops around the world and the amount of storage that we've got, in other words, supply-demand report, we don't think, I know we don't think as a firm here, that the market properly adjusted Argentina. We think that they're too light. And we would expect to see in April another reduction come in. That would not surprise us at all. In the meantime, the corn numbers were bullish. So for whatever reason, we think they got corn accurate, not the beans. Corn's up again. Now, how many weeks do we have over the upper Bollinger Band? We know this week. Last week, that's 2. The week before, no. So you got a 3% chance. Remember, a 5% chance of staying over? Now it's down to 3. Momentum pointing up, trend up, bias up. That's the bull part of the market. In the wheat market, you've got 2 weeks, I believe, over the upper Bollinger Band. Momentum's up, and yes, you're getting a correction in the markets right now. But for the week, you're only down 3 cents. The daily charts look deeper than that in the break. But you also have a market that just got the longer-term 18-week moving average over the 100. Now that happened, let me just say, I think it was this week. Yeah. So I will not be surprised at all to see how the market plays here, but I still think the market has turned itself longer-term bullish. Obviously, if you took out 444.5, I'd be questioning if my rationale's right any longer, because that would break the higher high, higher low pattern. And certainly if you closed under these moving averages, I'd have to rethink everything. In the cocoa market, it's been a runaway on weather. And weather has been very serious in hurting the crop. Now, this market is just pushing higher. It's a runaway market. Yes, it corrected today, but as you can see on the chart, it's been a runaway. You went from 2051 up 10%. Up to the 20, actually this week, 25.29. A lot of people in trading will look in futures at a 10, 15% move and say because of the leverage and all that they'll see profit taking coming after that. Again, it's another rule of thumb, and I'm giving you, decades of my experience with it. Higher highs, higher lows, certainly bullish. Over the upper Bollinger Band, oh yeah. What are the odds of staying at? 5% of the time. Were we up and over it last week? Market was 23.20, and it was over the upper Bollinger Band at that point too. So that's 2 weeks in a row that you've got it, so another 3% chance, and even crossed the 100-week average. In the sugar market, you continue bearish. The market has a pattern of lower highs, lower lows. It is still got downside momentum. Remember, on the weekly charts, I don't look at overbought, oversold. I just view it as momentum. You have to make adjustments on weekly charts for certain things. The stochastics is how I read it that way. You don't have to agree. It's just the way that I teach it and believe in it. In the coffee, momentum still down, trend down, lower highs, lower lows. That can all change if you get over 122.40, which happens to be the 18-week moving average of closes. So at least I know where the resistance is. Should the trend continue down, the 115.65 level could come in. In the cotton market, look at how this worked out. It's fascinating. Here's the market on its break. It steps out of its uptrend right here. It had had a pattern of higher lows, higher highs. You get an outside week down, the next week you're down. Often, prices run to the 18-week or the 18-day moving average of closes, depending on the chart you're looking at, and look for support there to try to figure out what to do next. Market breaks down the week of February 9th. Goes down, if you look at this low, 75.11, just missed hitting the 18-day average last week, and market bounces away. Market still bouncing away, goes up to the upper Bollinger Band, and now the question is, what next? It did not hit the 18-day average. It missed that by 10, 15 points, but that's where you were. Momentum is up. The trend is not up. You have no trend. You got a lower low and a higher high into a resistance point again. In the cattle market, the short-term trends are down if you look at the daily charts, but you got a heck of a bounce out of that today. And why did the bounce occur? I think it occurred because you've been playing at the 18-day average of closes on the weekly chart, and that offered the first level of support. It wouldn't surprise me if you try to bounce a little bit more here, and then if you reverse under these lows, could get very interesting. Momentum is pointing down. The market held on the upside bias, and the trend on the longer term weekly chart is still up. In the hog market, the trend is down on the weekly chart. Lower highs, lower lows. The market closed at 67.85, which is under the 18-week moving average of closes. With that momentum, still down. In order to wrestle control away, you've got to take out 71.95 on this chart. And from where you're at right now, that's roughly 400 points. It's a heck of a move. I would expect to see more selling right in this range of 68.38 to 68. There's no 38. It's 7.5 to 68.70, let's say. When we take a look at all that and put it together, the question is, what can we do for you? And I try to put it together with my market research. Now, as I said, I'm writing a gold report. I'll probably have it out early this week. I was going to write it. I began saying it on Tuesday or so. So much started happening. I didn't realize we were doing the tariffs on Thursday. Now the North Korean talks, that's another wrinkle in everything. Gary Cohn, top economic advisor, resigning, if you will, threw everything off. So I'll get to it now. How do you get this? You're going to give us a call. You can go to our website, sign up for any of our free offers. That'll get you on my mailing list also for my webinar that's coming up on Thursday. That's this coming Thursday at 12:30 p.m. Central Standard Time. Again, seating will be limited. I'm Ira Epstein. You have a good day, and I will talk to you all come Monday.